Hi, Mr. Atul Mehra.
Hi.
It's good to have you on board for this. So, for our investors to have a clear picture on how next financial year going to be, and about the current financial year as well. And Atul Mehra is the fund manager at Motilal Oswal, and he's handling BOP, which is the Business Opportunity PMS. A few things that I learned about you when I was, just checking on your profile. You are an investor since 13 years. When we are just beginning our team, you were investors since then, and you're a CFA holder, and it's been a decade that you are holding a CFA degree as well. And you be out of 20 years of investing, 14 years you have professional experience in investing.
Yes.
One more interesting thing I learned about you was that you manage the skin in the game, but also the soul in the game. Not just the skin, but also the soul. That was a very different, unique thing which I found about you. And one more thing I was confused about. What was that family equity allocation that you mentioned? What was that?
Sure. So thanks firstly for having me on your interview. Thank you very much for that. So my journey in investing began in 2001. Coincidentally, it was because of an event which was 9/11. So when 9/11 happened, my daddy used to own some shares and he was keen to sell those shares. And so the next day, me and my mom, we visited the stockbroker for the first time. And that was my first experience about learning about what stocks are.
Okay, that was back when you were 13 years old.
That's right. That's right. And generally being curious about how money is made and so on and so forth, I was curious about the stock market. So I happened to ask my mom what these stocks are about and so on and so forth. And that's how it started. Demat was very new then. We opened our Demat account. Shares used to be in physical form, so we got those shares dematted. And that is the start of the journey. Coincidentally, it was also a time when after 9/11, stock markets globally bottomed out. And Sensex at that time was 2,500, not Nifty. Sensex at that time was 2,500 after 9/11. So in the next, I think 7 years, from 2001 to 2008, the Sensex was up from 2,500 to almost 21,000. So coincidentally, I would say that it was a time when I think the journey could not have begun at a better time because it was just the low of the market and like things were only looking upwards from there for the next 7 years.
So do you think, is it okay to time the market? Because when you say it's the right time to enter the market, or so do you think it's good to time the market, or is it possible to time the market?
So right time is always generally seen in hindsight. So like I tell you now, it was like, it's very easy to say now that 2001 was the perfect time, but at that point in time, there was so much panic and globally markets were selling off. So it's very difficult to time the markets on a forward-looking basis. In hindsight, it is always in terms of easy to know when the markets were like. Similarly, if you look at the recent times around COVID, the market sold off 40% in like 3 weeks' time, right? And most people were panicking on, like, this was seen as one of the largest in terms of disasters humanity has ever seen. So there were a lot of questions. Forget about stock markets, like people are having health issues. There were questions about what will happen to humanity. So many of these things, like in hindsight, they look like great opportunities, but as you live those events, it's generally very difficult. So I would not like typically advise timing the markets.
That's very true. So how and where do you invest your personal money? Let me start off with that question first. So how and where do you invest your personal money?
Sure. So I think that in terms of alignment of interest with clients is very important. So normally, if you look at it in terms of my own money and my family money, all of the money in equity is in the same products as my clients. So if you look at it, the way I think about it is like every morning when you wake up, when you're doing your work, it is important that you have 100% focus on that work and not on in terms of your personal investing. So having your interests fully aligned with clients, that I think is very important from that regards, because you don't have any undue distractions and You're not thinking about your own personal portfolio, your personal stocks, and so on and so forth, which generally come at the cost of, in terms of clients, in terms of attention, and so on and so forth. So I just believe that being fully aligned with clients is very important. And hence, to that extent, all the money that I have in equities, along with my family money, is in the same products as my clients.
So which means like you have that part of connectivity with the clients.
That's true. That is very much true.
I think that's the one uniqueness this product has.
Yeah.
So talking about that, about the product, so could you just explain about the QGLP process with any examples so that our investors will have a clear idea on it?
Sure. So QGLP stands for quality, growth, longevity, and price. So these are the 4 pillars of investing that we typically look at before we identify any particular stock to invest in. So what does this mean? So quality is quality of business, quality of management. So we need a business which earns return on capital over cost of capital over a long period of time. That also has to be coupled with a good quality manager, either the promoter or the CEO of the company. They have to be of good quality in terms of ethics, in terms of integrity, in terms of competence, and so on and so forth. Growth mindset, and some of these more qualitative elements. Second is growth. Like in equities, without growth, it is no different than fixed income. So growth is a very important element of equities as a asset class. Third is longevity. So high quality business and high quality growth. For 1 or 2 years, it doesn't make the difference. But if you look at it from a longer term perspective, that is what makes a lot of difference. And fourth is in terms of price. So all these 3 elements of quality, growth, and longevity, those have to be bought at an appropriate price for us to be making high returns. So just to give an example, like in the portfolio context, like one of the stocks we bought in January 21 was, say, Safari Industries in the portfolio. Now, this is a stock that we bought when it was about 540 rupees. We bought about 3 to 4% of the company's equity from Tano Private Equity, who was exiting, and we bought it from them. And if you look at it at that point in time, the company's market cap was about close to 1,200 crores. From like taking you through each of the QGLP lens, so quality of business, it was led by Mr. Sudhir Jatia, who's a very strong player in the luggage business. He's been in the business for over 30 years, and he's a veteran in the industry. From a quality of business perspective, if you were to look at it, the business was transforming from being a more outsourced manufacturing to in-house manufacturing, as well as from sourcing from China to sourcing from Bangladesh. And the business was also gaining scale in terms of size and so on and so forth. So that is the quality of business element. Growth-wise, if you look at it, the business, in our opinion, was expected to grow at over 30% in the next few years. And from a size of opportunity perspective, it's a more oligopoly market between the luggage players. And Safari was clearly gaining market share from hardly having any market share to about 17-18% market share at the time that we bought the stock. Third is in terms of longevity, like both these elements around quality and growth, we saw that there is a very high longevity to both these elements. And finally, in terms of price, so the market cap that we bought it as was about close to 1,200 crore rupees. And we expected that this is a business which can do about close to 12 to 1,300 crores revenues in 3 years' time. It can do about close to 100 crores profits in 3 years' time, and so on and so forth. So already, like if you look at it in less than 2 years, this year the company should end at about close to 1,200 crores revenues, about 120 crore profits. So at the price that we bought it at, it was at 1,200 crores. There's almost like 11 to 12 times price to earning multiple on a forward-looking basis. And consequently, if you look at the output, the results, the stock has been up by about close to 4 times for us since the time we bought the stock. And from 500, it's almost about 2,000 rupees now. And that is how the journey has been. So if you look at it, all the 4 pillars of QGLP, we thought about it from this perspective.
Okay. So when you talk about QGLP process, I just want to have one question. I don't know if I could ask this, but I just want to ask this. So if you're given a choice to pick one, what would you choose? On one hand, you have good business. On the other hand, you have good business leader. So you have 2 in your hands. So if you could choose one, what would it be?
I think that's a brilliant question. I've thought a lot about it in terms of which is a more important parameter. And the conclusion that I have come to is basically, I think that it is generally the jockey that matters more than the horse. Because if you have a horse which is of not the right capability, uh, you can always replace the horse, but you can't replace the jockey, especially in an Indian context where most of the businesses are run by promoters.
Yeah.
So the promoters own 50% plus of the equity of the company. So it is unlikely that you can replace the jockey in the Indian context. Globally, like a lot of businesses are fairly widely held, and there you can change the management and so on and so forth. But in Indian context, where most businesses are majorly owned by the promoters, in many cases it is impossible to replace the jockey. So between the two, I would say that the jockey matters more. The quality of management matters more than the quality of business. Like even if you look at a classic case of say Berkshire Hathaway globally, it was a terrible business at the time that Warren Buffett had bought the company. It was a textile company and it was ailing in terms of operations, and it was eventually destined to go bankrupt. But it was the quality of management of like Warren Buffett and later Charlie Munger that transformed the business to being this $500 billion company that it is today. So I think that between the two, quality of management matters about more.
So you say bet on not to bet on the horse, but bet on the jockey.
Yes, very much.
That's very true. So moving on, do you think it's the right time to invest in Indian equities in the thinking the global backdrop that we have today, being the market being very volatile? You think it's a good idea to invest in Indian equities?
Sure. So, Akshara, like what I feel is, as normally like in equities, it is often seen as a 1-year thinking and 2-year thinking. And it's always like most people want to be better off in equities versus fixed income on a year-to-year basis. But that is typically not how equity works. So the way I think about it is in terms of equity, it has to be looked at as an allocation. And why I say that is the reason why people come to equities is very simple. You make 7-8% return in fixed income. If you're happy with a fixed deposit at 7-8%, there is virtually no need for anybody to come to equity. The reason why people come to equity is because they want that higher return. That like basically if it's 7-8% fixed income, you want to make 12, 15, 20% return. And that is the reason that you come to equities. Now, the funny thing about equities is that in terms of in any given year, you'll see that every decade, like you have one event in terms of global or local, because of which the stock markets go down by 40 to 50%. And you cannot predict which will be that event. Like you could not have predicted 9/11, you could not have predicted COVID. So many of these events come without notice, and your stock portfolio will be down 50% irrespective of the quality of the companies that you bought. So hence, having a longer term horizon is very important to begin with. Just to give more construct layer, like you would say that why should I come to equities if you tell me that for tomorrow, like for any given reason, the stock market can be down 40, 50%. Why should I come to this asset class? And the reason I would say that is the reason that the key reason being that the power of compounding works magically in the long term. So if you look at it, if you look at a fixed income instrument today, and say for example they make 5% return on a post-tax basis. So given a very long-term horizon, just talking about it from a real long-term horizon basis, say 50 years, you start your career at 25 and 20 or something, and then you live on to 70 years or something or so. So say from a 50-year horizon, if you compound your capital at 5%, your money will be up 10x in 50 years time, right? That is the rate of return that basically any fixed income will generate for you. Now, the magic part about equities and any other asset class which has the ability to generate higher returns is that at 5%, you're say 10x in 50 years. At 10% rate of return, you're up 100x, right? And at 15%, you're up 1000x. And at 20%, you're at 10,000x. Now, if you look at somebody like Warren Buffett, the reason why he's worshipped all over the world for his investing genius is that he has done this. So for 50 years, he has generated returns at 20% versus the S&P 500, which delivered returns at 10%, which means that if you had invested at the time that Berkshire was taken over by Warren Buffett in S&P, you would have made 100x your principal in a 50-year horizon. And with Buffett, you made 10,000x. So that is a staggering degree of exponentiality that like higher returns can make over the long term. And that is the reason why even if there is in every decade, one horizon, 1 year when the market's around 40-50%, even then it's worth being in the market because of this exponential potential. So the drawdowns, I would say, are the cost of this return potential. And like somebody who cannot take that drawdown will not be able to see the upside potential that the asset class has in the longer term. So hence, every now and then, like you will see, there has never been a time horizon where even in the last many years that you'll open the newspaper and you'll see that today is the best time to buy equities and you'll make a lot of return if you buy equities today. So there has never been such a scenario and there will never be such a scenario. The world will be a volatile place. The world has been a volatile place and you will have all kinds of news flow, local, global, interest rates, geopolitics, natural disasters, human disasters. You will have these things all the time. But if you have this horizon and then if you can allocate, like if you are, say, for example, able to allocate 30, 40, 50% of your capital to equities, and then you put your 50% in safe asset classes, say fixed income or whatever, then you are more balanced in your approach. So I would say that take that approach, look at equity as an asset class. And once you look at it that way, you will draw a commitment towards equities and you will not be bothered by the day-to-day movements of what the Fed is doing, what is happening in Russia, and so on and so forth.
That was a clear-cut answer for diversification of funds from an investor's perspective.
Yes.
Thank you for that. And let's move to the last question for the day. So can you just talk about this BOP PMS and how its performance and how did you construct that?
Sure. So the way we think about BOP as a product is we look at businesses across market caps, across sectors, and try to build a portfolio about close to 25 to 30 stocks. At this point in time, we have about close to 22, 23 stocks in the portfolio. And we pick each of these businesses in the portfolio from this similar QGLP lens. So at this point in time, if you look at it, the portfolio return on equity is about close to 21%. We expect earnings growth in the portfolio to be about 20% CAGR in the next 3 years' time. Many of the stocks that we own in the portfolio are of high quality and hence high longevity also for many of the names that we own in the portfolio. And from a price perspective, the portfolio trades at about 16 times current year expected earnings and 10 times 3 year out expected earnings. So from all the 4 elements of QGLP, if you look at it, the portfolio is constructed well on each of the 4 pillars. So that is the thought process with which we have built the portfolio. The portfolio will have a mix of businesses which are large and where there is an established moat and very strong franchises. And it will also have a fair bit of mix of mid and small cap businesses, which can be the future large multi-baggers in the portfolio construct. And also, I like to add that given that the fund is young in terms of AUM, it has the ability to buy mid and small caps to a meaningful proportion, which if you look at a typical flexi cap fund, if it is very large sized, automatically all the money goes towards larger names. So we don't have that disadvantage. We have the advantage that being low in terms of AUM, absolute AUM, it has the ability to meaningfully allocate across market caps. And hence we see that as an added flexibility. So that is the broad thought process on the portfolio. In terms of the recent performance, like if you look at it, the last 12 months, let's say the current financial year of FY23, the portfolio in a difficult market environment has outperformed by about close to 6 to 7% on a post-fee basis. So that has been the more recent performance from a portfolio perspective.
Okay, with that, we have come to the end of the session. So thank you, Mr. Atul, for having your time for us, for the investors, to have more knowledge about the product as well as about the macros, as well as about the financial year. So thank you from PMS Bazaar then. So
Thank you very much, Akshara, and the entire PMS Bazaar team. Look forward to having more such interactions in the future. Thank you.
Thank you.